one of the things that we look at in the textbook when we look at a pro forma, let's say it's a 10-year hold period, is when all is said and done and when the dust settles, we have some net cash flow to equity number, which includes both operating period cash flows and then the net proceeds from the sale after any debt has been repaid. And one of the metrics that investors, especially institutional investors, like to look at is what's the percentage of that total net cash flow that is related to just the residual versus the operating period. And so there is some threshold above which investors don't want to go. In other words, a really terrific sale can absolve a lot of sins along the way. But where's sort of the safe zone where you want to get?
It depends. Interestingly, we're in an odd moment in history because of these extremely low interest rate environment that exists today, where your alternative is a 10-year Treasury at 1.5%, 1.7%, and it has created a situation where for really high-quality assets, really high-quality cash streams in very liquid markets that people want to be in, central New York, central D.C., the cap rates have gotten bid to a very unusual position where in a 7-year hold, you may only be getting 25-30% of your investment back through cash flow over a 7-year period, and 70% of it's coming from the residual. Now I say that's an anomaly of that for those assets. The cap rates have gotten very low. The spread over Treasury is very low, and Treasury is low, and so you aren't getting much of your money back. And institutions are kind of swallowing hard and saying, "Yeah, but it's such a great asset in an uncertain world." More normally, I would think that the world more normally in my career says, I'm going to hold it 7 years. I roughly want half of my money back from cash flow over the 7 years, and I'll take the rest of my return from the residual. And if you think about it, it says, gee, if I can get a 7% cash on cash for 7 years, there's no magic to it. Again, it depends on the nature of the property. You show me something very risky, I'll give you a great example. There's a place called Williston, North Dakota, where the oil finds, fracking-related oil finds, have caused an explosion. So here's nowhere land.
Right.
There's nothing near it. You have to truck everything in. And by the way, it is a huge economic growth area as long as oil prices stay above $70 a barrel.
Mm-hmm.
But what happens if oil prices fall to $68 a barrel? Well, it's no longer profitable to extract. They'll shut down in a heartbeat, and suddenly all this drilling stuff will stop until prices go back up above $70 a barrel. You talk about a market like that where the only reason they're there is because oil is above $70 a barrel. And as long as it's above $70 a barrel, there's a lot there, but if not, there's nothing there. It's a ghost town. Tell you what, I better get all my money back in 2 to 3 years, all of it back in 2 to 3 years. And because I have no visibility on what the market looks like for oil in 3 years, I mean, I can make a guess. But if I'm going to where it is either a ghost town or a boom town, on a razor's edge, tell you what, give me all my money back. Afghanistan. Suppose I gave you a building that you could build and lease to the U.S. government for 2 years in Afghanistan. So if you build it, the U.S. government will lease it for 2 years. Well, you're going to tell me I want all my money back and a profit in 2 years from cash flow, because you're afraid that if the U.S. government leaves in 2 years, you're stuck with a building in Afghanistan nobody wants, and I've got to get all my money and profit. So those are kind of the extremes. But if I had to say on a 7-year hold, Norm, 35% would be on the low side, 75% of my money from cash flow would be on the high end, 50% being kind of on the, with normal leverage. This is not with abnormal leverage. That would be the range.